Hello everyone. Today I want to take a look at the second largest bank failure in US history. We're literally witnessing history as it unfolds itself, and the past month there's been three major bank collapses. Number one being Silicon Valley Bank, which collapsed on March 10th on a Friday. It's currently March 13th as I'm recording this now. There's also been Signature Bank and Silvergate Bank, the latter two being related with crypto. So, first off, I wanted to take a look at the Wall Street report and and then we'll look at some notes that I've taken. So, here's the Silicon Valley's bank meltdown in a visual form. Once again, if you guys don't know Silicon Valley Bank, their major clientele is venture backed tech companies. And so we're going to be looking at the numbers, but they're dealing with a customer base that has millions to billions of dollars of assets of cash within this bank. And so one of the reasons why SVB failed was that they were not really diverse within their customer profile. So for example, if they had different industry type customers, then they might have mitigated the risk. For example, Silicon Valley is a very networked place. So if one person was texting within, they got a text message from their venture capital or their investor, you need to take this out, then this, whether the rumor may be true or not, that message gets spread really, really quickly. And a bank run usually occurs when the depositors, they feel they have concerns over the insolvency. And insolvency is when a bank is not able to pay back their debts. When the depositors have concerns over the insolvency of the bank, that's when a bank run occurs. So we know that in 2008 there was a global financial crisis, and the biggest bank collapse was the Washington Mutual Bank. They had assets of 377 billion with deposits of 188 billion. We know that bank runs occur quite frequently from 2008 to 2014, with around more than 500 banks failing. And here are the results of the deposits and why it kind of led to a bank failure. So starting from 2019, we know that there was 0% interest rates when COVID was occurring. The Fed, brought interest rates to an all-time low. So the cost of borrowing was free. It would be silly if you weren't, refinancing your mortgage, or if you were not taking out money to invest, right? And this is why asset prices were highly inflated. A lot of money was being put into new startups. And that's why we see a huge demand, kind of like huge influx of depositors, right? That's kind of how I view this graph. It's like a demand due to the high interest rates. And then the decline is not only because of venture being sucked out of the market, but it's also because there's a lot of companies that were actually built during this time that has to meet their payrolls. So as you can see, starting from 2022, well, more so of like late stages of 2021, you could see a huge kind of drop down, right? There's a lot of outflows happening. And there was $42 billion that this kind of built up to of attempted withdrawals on March 9th. And yeah, this is another classic definition of a bank run. When people are panicking, then you could see such a large increase. And we'll kind of look at this in a game strategic way as well. We also know that there's a program called FDIC, which insures up to $250 worth of depositors, $250,000 worth of an account. So that you're insured by the government. But within SVB's case, because their clientele is we're dealing with tech companies and tech founders that has millions to hundreds of billions of dollars, then there's going to be a large base where it's going to be uninsured, and that could be a reasoning for why there was such a huge amount of depositors that wanted to get out. And last but not least is the bonds that Silicon Valley said that it would hold until they matured. So they actually had to sell their $21 billion bond portfolio at a $1.8 billion loss to meet the demands of the depositors that were pulling out money. So as you can see that they were, buying a large amount of bonds from 2021 to 2022. And as we could look at the graph, large of inflows, what do they do with their money? Usually they either give out loans, or they could, with the cash that they get, they could buy treasury bills or MBS, which is mortgage-backed securities, or other securities. But as it kind of, capital was getting sucked out and there was more outflows rather than inflows, they had to kind of sell it at a loss. And that's what this graph kind of represents. I hope I'm explaining myself properly. And if I'm not, feel free to let me know in the comments below. So now I want to take a look at kind of like the notes I've taken. So first off, we went over this point. We know that SVB, Signature Bank, and Silvergate collapsed. The reasoning why? Again, the banks are required to hold 10% in reserves. Bank usually keeps 10%. And the remaining, they could either give out loans or cash. And what the Silicon Valley Bank and lots of banks do is they usually buy treasury bills, mortgage-backed securities, or other. But the reason why they invest in these type of treasury bills or mortgage-backed securities is because they could earn on interest, right? This is how they make money, on using other people's money. And a bank run is what occurs when they can't meet the demands of deposit withdrawals. We went over that. Large number of deposits over concerns of bank insolvency. Yeah. So if everybody, imagine if you and me, like all of us, had some type of concern that, let's say, JP Morgan or Bank of America, like they're going to be insolvent, and we try to withdraw our money, that will definitely result in a large collapse. But also we have to recognize that large banks have economies of scale. So they have, lots of resources. That 10% could definitely be in the ranges of billions. So so if more than 10% of the population decide to do this, then there's going to be a bank run. But the odds of that, I think, are very low. For major banks, at least. So let me give you an example of why they had to sell their bond portfolio. Because you might be wondering, like, why would they not just hold on to their bonds if they're, getting a guaranteed percentage? So what happens is, like, they were buying a lot of bonds, let's say at 1%. I buy a 5-year bond at 1%. But as interest rate rises, let's say it rose to 6%, then this 5-year bond is much more valuable compared to the 5-year bond at 1%. So in this case, my bond portfolio actually goes down. And this is the reason why they had to kind of sell their bond portfolio at a loss, in addition to, a lot of depositors trying to take out their money. Again, we discussed how FDIC insures up to $250,000, but looking at the Wall Street Journal report, we saw that there was lots of their customer base, majority of their accounts, it was more than $250,000. So here are some companies. Oh, my apologies. It's not hundreds of billions, it's billions of dollars. So I made a error in my speaking earlier when I stated that these companies had hundreds of billions of dollars. That doesn't really make sense. It's billions. So we have Circle. I believe Circle it's a crypto related company, and I'm pretty sure they create stable coins. So they're behind USDC. And this is the reasoning why from $1, the USDC crypto coin, it was pegged to $1, it had to depeg, and then it went down to like 97 cents. But now it's back to, I think, back to $1. So that just kind of also shows like what occurs. These are some ripple effects that occurs. Roku 487 million, BlockFi 227 million, so on and so forth. And these are only the companies that have disclosed their exposure so far. But as of Monday, which is today, the Fed announced systemic risk exception for depositors, meaning depositors will have access to all of their deposits. So this is kind of a way for calming the ocean, calming the tide. And for other banks, they also created like a bank term funding program, which means that banks can swap their government backstop mortgage bonds for cash for a year, I believe. What's also interesting, I actually got this insight from Coffezilla, a very, very great journalist. Yeah. And he reported that Greg Beckler sold a $3.6 million worth of shares prior to the collapse. This is very interesting because he also lobbied for raising asset threshold at which banks would be considered systematically important. So he kind of argued for deregulating banks, but when things went south, they're considered systematically risky and require a bailout, kind of asking for best of both sides, which is not really possible. So systematically risky banks usually get special treatment, as we see, that they got bailed out, but regular banks don't. That's another kind of interesting insight. So this is interesting insight because then we have to think about the incentives. Does this incentivize banks for taking risk? Like too big to fail banks, they should also, they one of the reasons why a problem for the global financial crisis is the bailouts. Like too big to fail banks, they need to be held accountable, and incentivizing banks to take on risks, that's not really good because we've seen what happened within 2008 with predatory loans that really affects consumers and daily people's lives, So that's I thought that was interesting. All right, I had to redraw my 2x2 matrix because my payoffs were wrong. So let me describe what I drew out. On the row, we have player 1, and on the column, we have player 2. Okay, so player 1 is over here, but I just put it down here for more space. Okay, and we know that both players have two strategies within this context. They could either hold their deposits, in which they would be getting a payoff of 0 and 0. One player could be holding while the other one withdraws. In this case, player 2 is gaining 0, whereas if I'm holding my deposits, I'm losing 10. And 10 could be kind of viewed as utility. Or, it could also mean the amount of losses that I'll be having. And this is just like a simplified way of describing the concept. Okay, and same thing. Let's say player 1 withdraws and player 2 holds. Then player 1 kind of gains 0, which is the utility of taking out all of your cash. And player 2 loses because they run the possibility of not being able to get their funds back. And let's say both withdraws. -9, -9. And now we're going to find Nash equilibriums, and this is the strategy profile in which both they have no incentive to deviate. Okay. And how you do this is first we look at what happens, what would player 1 do if player 2 plays the strategy hold. So we look at the payoffs. If we look at the payoffs, we know that player 1 would be indifferent between 0 and 0. So let's highlight that. And let's say player 2 plays withdraw. Then what will player 1 do? Well, player 1 would be playing withdraw because -9 is greater than -10. Now let's do the same case. Let's say player 1 plays hold. what would player 2 do? Well, player 2 would be indifferent between 0 and 0. Let's say player 1 plays withdraw. What would player 2 do? They would be playing withdraw because -9 is greater than -10. So as you can see, best response over here would be to hold and hold. And the next strategy would be withdraw, withdraw. But, from an outsider looking in, what do you guys think would be the best thing to do here? I would say hold and hold, right? Because, if everybody holded, we're not losing anything. But that's not what happened, right? Although everyone knows that they would be better off if they hold it, due to the uncertainty of what the other player would do. From here, we went to here, where everybody's withdrawing, as we saw from like the picture of the Wall Street Journal. So the insight from here is that the beliefs of the fundamentals is just as important as the fundamentals themselves. It matters just as much. Now I want to conclude with talking about what will occur. There could be ripple effects, which we're already experiencing now. So there's a lot of regional banks. As, for example, I'm not sure if I discussed that I'm currently residing in Los Angeles, and there's a bank called Republic Bank, and there's people lining up to get their deposits. So we don't know what type of impacts this will have on the economy. There could be further regulation of mid-sized banks. Let me actually check these off. And currently there's solutions to prevent another SVB collapse. For example, Mercury's $3 million FDIC insurance account program. And we also know that in addition to this, there's going to be lots of healthy banks that is very hungry and taking opportunity. So, in addition to Mercury, other healthy banks such as Goldman Sachs or Chase Bank, Bank of America, those banks are going to be high in demand because now the firms who have exited from the Silicon Valley Bank, which is, I believe, like a top 100 bank, they have new demand. They need to help these people, and these firms they have demand for reliable banks to park their funds. We saw millions and billions of dollars. So, these banks are going to be hungry, and there's always opportunity in times of fear. Again, talking about economies of scale, big banks have resources and opportunities that are unavailable to small banks. We also don't know how politics is going to come into play. For example, like maybe there's politicians that are going to be utilizing this as to figure out certain solutions that might have an impact in other ways. And last but not least is interest rate versus financial stability. As interest rate rises, there's a trade-off, for example, of what happened. There was some financial instability within these banks. So we're not really too sure whether interest rates are going to continue to rise to slow down inflation, or if it's going to stop because of the financial uncertainty that will occur. So yeah, I'm not really sure if I did a really good job of explaining myself, but hopefully I get better. Please feel free to let me know in the comments below of some ways I can grow. I definitely think there's some knowledge gaps that I need to get better at, but that's the kind of overall report from my understanding, and I hope this is informative. I hope this was informative and you guys learned a thing or two, and just staying curious about how our world is moving in the macro scale. Although it might not impact you in the micro scale, it's still important to understand because it gives you a better understanding of the world. And even if it if it might not affect you directly, it is going to have impacts on people around you. It is, I mean, in fact, like inflation affects everyone. So surely it does have some form of impact. But with that stated, hope you guys enjoyed, and I'll catch you guys soon. Take care. Peace.